Okay. Now we're going to get into scalping gamma. Now scalping gamma is just right here. From when we buy options, we're going to sell stock. That's all I mean when I say scalping gamma, is instead of covering our options, we're going to sell stock. So 3 different examples, well, 3 different options trees, 1, 2, and 3. So starting here on 1, last trade $13. I have the calls in green and the puts in red. Let's buy a phony baloney 10 lot at the 14 strike for the calls. Now when we do this, last trade in the stock is 13. All we're doing is we're buying stock at 14. Okay? So last trade 13, we're buying the 14 calls. We're long volatility. If these are weeklies and it's Thanksgiving, we probably shouldn't expect this stock to move to 14. It's a low volatility week. We probably want to be selling these 14s. But I doubt we'll be able to get enough premium that it's worth our troubles. So nevertheless, let's buy 10 of these 14s. Now in part 2, the stock goes up to 15. We're still long 10 from 14. Now I didn't put any prices on here because I don't want to get caught up in prices. Prices doesn't matter for this example. When we're long those 14 calls, we're long stock at 14. Now last trade in the underlying is 15. If we want to cover those calls, we can sell 1,000 shares at 15. Because when we're long 10 from 14, that's the same as being long 1,000 shares at expiration at 14. When we sell 1,000 at 15, we're taking away our upside because we're covering our trade. But we're also taking risk off the table. We no longer have risk in this trade. It's advantageous. It's far better than selling those 14 calls, unless you can get a really good price on this. Unless there's a market like Apple. Unless those 14 calls are trading above like $1.40 or $1.50 and you can get out. But if you're not, most of the stuff that we're trading is not necessarily going to give you great markets. So what you can do is you can sell 1,000 shares at 15. Now, if this stock goes to 20, you don't care. You're done because you're long 1,000 at 14 and you're short 1,000 at 15. Okay? So just let those expire. You just made $1,000 less whatever you paid for it. You're done. Now in 3, and let's call this expiration, if this same stock now drops down to 12, our 14 calls are going to expire worthless, right? So those are 0. So when we sold this 1,000 at 15, we did so because we were long 1,000 at 14. But now with the stock at 12, these calls are now 0. So we have to buy back these 1,000 shares. So in this trade, we were able to make $3,000 from selling 1,000 at 15 and buying them back at 12. And that's why you really want to trade stock and not necessarily just cover your options. We covered our upside, right? We have no more exposure on the upside, and now we have unlimited exposure on the downside, at least down to 0. We just synthetically rolled our long call into a long put. Because if you're long a call and short stock, we just synthetically made ourselves long a put. You would use this methodology whenever you want to limit your risk. Whenever a stock is moving, like that B square moved around, but it didn't really go anywhere until finally it moved. When a stock's moving around, if you want to limit your risk, so in this example, we're long 10 calls from 14, you can sell up to 1,000 shares. So at 15, if you could sell 200 shares, 300 shares, you're reducing your risk. You're locking in your profit and reducing your risk. You can't sell 1,100 shares or 1,200 shares because then you're taking then you're going to have short exposure. So if the stock goes up to 25, you're going to lose money. But you could always think of it that when you're long 10 calls on the 14 strike, you're long 1,000 shares from 14 at expiration. So at any time you want to limit your risk, you could always sell shares. And all the trades that we put out, we know those trades are cheaply priced relative to where they historically trade. So we already know we're in there with good value. Now we're just looking for more escape paths. And what this does is, last trade of the stock is 13. If that stock goes from 14 to 12, 14 to 12, 14 to 12 every single day for 10 days, for somebody not familiar with this strategy, they might look at it as a terrible trade. But for me, I look at that as saying, wow, that's a great trade. I'll do that all day if this stock is volatile, 14, 12, 14, 12, 14, 12, but it's not really going anywhere. So it gives you another opportunity to make money and finance your trade, which is overall helping you manage your risk. Having this approach as another way to escape your position puts you in far better odds than just holding those calls all by themselves. So that's why you want to learn as much as you can before you're out there risking money. Because we go back to that example of last trade 13, if it bounces between 12 and 14, for somebody who's just long calls or long puts, they don't think it's a good trade. But where we want to be is we want to be able to take advantage of that.